In this video, I'm going to transform the way that you look at options in stock trading and explain why implied volatility matters so much more than the underlying when trading stocks or options. If that sentence didn't make sense, I will go into full detail by what I mean by that. In this presentation, I'm going to give you a short talk about what implied volatility is, and near the end, I will discuss ways that you can actively use this in your trading of stocks and options and the ways that you can use it to inform your investment approach. I will also go through examples of commonly traded stocks such as GME, Wish, and AMC and explain why there is an extreme mispricing of options and the way that you can profit from that. So the next few slides is the fundamental basis of the presentation, so let's get started. Okay, so what is implied volatility? Implied volatility is the amount that a stock or instrument is expected to move. This is determined by the market and expressed as a percentage. So the percentage of implied volatility represents the annual range of one standard deviation of the stock. Okay, and so if we briefly go to the next slide, this is the standard bell curve, and we can see that 68.2% of the range of the stocks is in the first standard deviation of the move. 95% in the second standard deviation. So one standard deviation move is very important to us because it tells us roughly where the stock may end up in the next year. We will go through a quick calculation to demonstrate how this works. So if a stock is trading, if a stock costs $100 and has a 25% implied volatility, that means that in 1 year, it will be between $25 down or up $25. This is the equation. You have the stock times IV over 100 times date to expiry over 365, and you take the square root of that. Okay, so let's go over one more example to bring this point home and see how it relates to option prices. Okay, so on June 28th, Apple is at 134.78 with an implied volatility of 23.65% on the September contract. If we look at the September 17th contract, which is 81 days to expiry, we can see that in 81 days, 68% of the time, Apple will be between 119.7 and 149.78. And we simply just got that by inputting those numbers into the formula. Currently, the Apple call contract for 135 strike sells for $5.80. Therefore, if we are at the end of the upside for the first standard deviation, or even we go into the second standard deviation, there is over a potential 100% gain for this call option. Okay, so because implied volatility is such a key factor in the formula, because it really calculates where the stock may end up in a certain amount of time, it really determines the option prices. Okay, so how does implied volatility get calculated? Well, ultimately, it is the market that determines the price and prices in the expected moves, and it determines the implied volatility of the stock. The market is a place of buyers and sellers. Therefore, wherever the marketplace determines that is a fair value for a stock's implied volatility, that's where the implied volatility rests. The whole premise of options trading is that you believe that the calculated move as dictated by the implied volatility is incorrect. Therefore, when you believe that implied volatility is too low or cheap, you can buy the option, or if you believe it's too expensive, you sell the option. Because most people are used to buying options, we will stick to that in our discussion. Now, the next slide is the crux of my presentation and what I believe is the most important take-home message. And that is that there is extreme mispricings of implied volatility all over the place. Let me give you guys an example. So AMC was trading at $12 a share on May 20th, 2021. It had an implied volatility of 120%. So that means that in 1 year, AMC is either going to go to zero or it's either going to be up by 120%. As you can see, that is a pretty expensive and large implied volatility for the stock. And the marketplace has correctly determined that this stock is very volatile. Now, despite this pricing, the implied volatility shot up to over 300% on June 2nd when it closed at $62 a share. So this means that even though the market is pricing in extreme levels of volatility, because it's literally pricing that it can go to zero, they are still mispricing it. It is still not enough. So, and this move overall represents a greater than 2 standard deviation move in the market. So the market makers therefore had to expand the volatility to match the realized volatility of the stock. And they had to expand the volatility to the 300%. This mispricing that happened, if we were to be very diligent with our options trading and have a reasonable long dated expiry, this could have yielded us a 700% gain. Okay, so next I'm going to go over how this happened in GME, Wish, and I will also show you the graph of the implied volatility of AMC. Okay, so the graph on the left is the implied volatility of GME options, and the graph on the right is a chart of GME. As you can see, in the first part of the rally, there was a spike in implied volatility, and then there was another spike of implied volatility during the second rally. And then we went into this phase where GME went sideways and nothing really happened. And you can see that the implied volatility contracted quite a bit. Now, the important piece to this is that if you were to buy AMC here and you still had the price here, the price that you bought here and here, it may be the same price, but we can see that it is a completely different stock because the implied volatility has moved lower, which means that the market is determining that it is a safer investment, that the move in GME is not going to be as large as it were to here. But we know that, well, what's the difference between here and here? And it could be your opinion that, okay, I think that GME is still the same stock. Therefore, this contraction in implied volatility is inappropriately priced, okay? However, we can see that when the trend line of the implied volatility slope broke, the price hadn't moved higher yet. And you can go look at this yourself on a shorter time frame. This is when you can potentially enter the options for this. Before this big move here, you can see that this trend line broke and option makers are slowly starting to price in a higher implied volatility. Once this breaks, then you can enter, and this was, I believe, like a 70% move. Next, we'll go over the chart of AMC and realize a similar pattern. So again, this was a spike in implied volatility during the first one, and this is a logarithmic graph. So spike in implied volatility in the sixth one, and then you can see that implied volatility, it really started to break out, and this is when you can start to get involved in AMC. A lot of the times, the implied volatility will start to move higher before the stock price moves, okay? And that's where we can get our advantage. But even though AMC had a, close to here, we can see that it was around 141%. This was not at all pricing in it appropriately because it really spiked up to 375% move, and that was the true realized volatility at that time. We can see a similar story with Wish, and here is the very interesting part. Is you can see, so this black line here, this black line is the price of the stock. It's here, okay? So this black line here, we can see that implied volatility was moving higher, but the price remained flat. And this is a huge bullish divergence. And we can see that, okay, the derivatives traders, the option traders are saying there's going to be something that's going to be happening in Wish, but the price is not going anywhere. So this is a bullish divergence, and you can either buy the stock here or you can buy the options. And then in this move was pretty significant. I believe that Wish went from around $8 a share, and it went all the way up to around $14. Okay, so one strategy that you can utilize is by buying the breakouts of implied volatility, as I discussed previously. You can also look at some extremely volatile stocks and realize that GME at this price, okay, is not the same GME at another price. So here, when the volatility is contracting, the price is moving sideways. But if you bought it at this price and you bought it at this price, it's not the same stock because the derivative traders are pricing in a different risk profile to the stock by contracting the volatility. So you can look at some extremely volatile stocks and realize that GME at a certain price is not the GME at another price because the volatility is going down, as I discussed in the previous slides. In other words, it is a completely different stock because the volatility profile has completely changed. Therefore, the risk in the stock has changed. If you believe that the market is being complacent about the pricing and the future moves of the stock, you can get involved and buy the options. Okay, so these are the last few slides. We can see that rising volatility implies a big move is about to happen. So, and this is kind of what we discussed in previous slides. When there's a bullish divergence between the implied volatility and price, you can get involved. And this is just a short slide about buying versus selling options. If you believe that implied volatility is too cheap, you are buying options, and if it is too large, then you are selling the options. So the dream is we want to find the mispricings. We want to find when these mispricings happen and take advantage of them. I will discuss this in future videos. Thank you for tuning in. And if you have any questions, please comment below. Cheers and have a good night.